Have you ever really thought about buy now, pay later? It feels like a simple perk, right? But behind that button is a massive, high stakes game of financial strategy that businesses are playing every single day. Today, we're going to pull back that curtain and dive deep into the art of credit policy. So let's get right into it.
So why do they do it? I mean, why would any company let you just walk out the door with their product before you've paid a single dime? Well, the simple answer, of course, is to make more sales. But that simple answer creates this really complex problem, this constant, never-ending tug-of-war between boosting revenue and managing the very real risk that they might never see that money. You see, when a business sells something on credit, it creates this thing on its books called accounts receivable. It's basically a formal IOU from the customer. Now, it's an asset, it has value, but it is not cash in the bank. And that, right there, is the crucial difference that drives every single decision we're about to talk about. Okay, so here's our game plan. First, we're going to look at the 4 main tools businesses use in this financial tug-of-war. Then, we'll see how they actually use those tools to decide who gets credit in the first place, how they can turn all those IOUs into cold hard cash, and finally, how they run the numbers to see if a big policy change is even worth the risk. A company's credit policy is basically its playbook for managing this whole process. You can think of it as 4 main levers that a business can pull to try and find that perfect sweet spot between encouraging more sales and protecting themselves from losses. Let's take a look at the first one. The very first lever is the credit period. This is as basic as it gets. How long does a customer have to pay their bill? Is it 30 days, 60, maybe 90? A simple question, right? But this single decision has some immediate and really significant consequences. And this just perfectly illustrates that balancing act we're talking about. A shorter period is great because you get your cash faster and there's just less time for things to go wrong. But you might scare off customers who need a bit more flexibility. On the other hand, a longer period can be a fantastic sales tool, but it means your cash is tied up for longer and, the chances go up that some of those bills just never get paid. All right, next up, credit standards. This one isn't about how long customers have to pay, it's about who gets to pay later in the first place. It's all about setting the bar for who you consider creditworthy. So how do you decide if a potential customer is actually a good risk? Well, businesses often use a framework like the 5 C's to make that call. They look at the customer's character, basically their reputation for paying on time, their capacity, can they actually generate the cash to pay it back, their capital, financial reserves, any collateral they can put up to secure the debt, and finally, the general economic conditions that might impact their ability to pay. And you guessed it, this creates another critical trade-off. If you tighten your standards and only lend to the most rock-solid customers, you'll have very few people defaulting. Awesome. But you'll also say no to a whole lot of potential sales. If you loosen those standards, sales might shoot up, but so does your risk of bad debt and all the costs that come with chasing down those late payments. The third tool in the kit is a classic incentive, the cash discount. You've probably seen terms like 2/10, net 30 on an invoice. All that means is the full amount is due in 30 days. But if you pay within 10 days, you get a 2% discount. It's a really clever way to nudge customers to pay early. Now, here's what's so cool about this. The logic behind why it works is fascinating. For that discount to be truly tempting, it has to be a better deal for the customer than just holding on to their cash and earning interest on it for that short period. And it turns out a 2% discount for paying 20 days early is equivalent to a massive annualized interest rate. So for most customers, it's a no-brainer. And that brings us to the final lever, the collection policy. This is the what-if plan. What happens when things don't go smoothly and an account becomes overdue? You absolutely need a well-defined procedure for this. An aggressive policy, think immediate phone calls, maybe even legal action, can get your money back faster, sure, but it's expensive and can seriously damage customer relationships. A more lenient policy saves you money on collections and keeps customers happy, but you risk waiting a lot longer for your money, or maybe never getting it at all. It's the final piece of that big balancing act. Okay, so we've got our 4 main policy levers. Now let's see how a business actually puts them into practice to answer a fundamental question. When a totally new customer comes along, do you grant them credit? How is that decision actually made? It's not just a gut feeling. Businesses use a really logical process, kind of like a decision tree. First, you have the choice, grant credit or don't. If you do, there are only 2 ways it can go. Outcome 1, they pay and you make your profit. Outcome 2, they default and you lose the cost of whatever you sold them. The crucial last step is to weigh each of those outcomes by how likely it is to happen. That gives you the expected profit. Let's make this real with an example. Say Company A is looking at a new sale worth $1,500 million. The stuff they're selling costs them $1,300 million to make. After doing their homework, they figure there's a 90% chance the customer will pay on time, but a 10% chance they'll default. So, should they take the deal? When you run the numbers, you get an expected profit of $50 million. That 90% chance of making a $200 million profit is big enough to outweigh the scary 10% chance of taking a $1,300 million loss. Because the final number is positive, granting credit is the logical, profitable move, even with that risk baked in. Okay, but here's another problem. What happens when a company has made tons of these credit sales and now has this huge mountain of accounts receivable, but they need actual cash, like right now, to pay their own bills? How do they turn all those IOUs into capital they can actually use? Well, there are two main ways to do this. The first is called pledging. That's where you use your receivables as collateral to get a loan from a bank. The second is factoring, where you literally sell your invoices to another company, called a factor, at a discount. The key difference here, and it is a huge one, is risk. With pledging, if a customer doesn't pay, that's still your problem. With factoring, that risk gets transferred to the factor. All right, for our last section, let's zoom all the way out from a single sale and look at the entire strategy. How can a company use hard numbers to decide if it should make a major change to its credit policy, like, say, loosening its standards to try and attract a whole bunch of new customers? They have to run a full cost-benefit analysis. On the pro side, you've got the potential for a lot more profit from all those new sales, but you have to weigh that against the cons: the cost of having more cash tied up in receivables, higher costs for collections, and of course the big one, more losses from bad debt. Let's look at one last case study, this one for company Inha. By loosening their standards, they figure they can boost operating profit by $720 million. That's the good news. But they also calculate a $36 million opportunity cost, $10 million more in collection costs, and a pretty big jump of $198 million in bad debt. So, is it worth it? Well, when you add it all up, the change is projected to increase their net profit by $476 million. The benefit of all those extra sales completely swamps the combined costs of the increased risk. In this case, the numbers don't lie. They should absolutely change the policy. So, from the number of days you have to pay a bill to the financing options you're offered on a new car, it's all part of this calculated strategic balancing act. It is a constant analysis of cost versus benefit and risk versus reward. The next time you see that buy now, pay later option, think about the levers being pulled just behind the scenes. What credit policies do you see the businesses around you using every single day? Thanks for watching.